and Mike, this is very much tech leading the declines, having, of course, over the summer propped the broader markets up.
Exactly. It really is just sort of a give back. Now, the S&P 500 also back to late June levels, but we didn't have the higher highs the way that the Nasdaq 100 did. Doesn't explain away the weakness. Obviously, the S&P itself, the index, has been in a little bit of a fragile state. We kind of lost that automatic rotational uptrend we had for a while. It seems as if we're not really talking about new kind of macro concerns making their way into the market. It very much seems flows and unbalanced index. The equal weighted S&P is down 2/3% today, relative to almost twice that percentage decline for the market cap weighted S&P. So it's still kind of getting oversold on the index level, but that in itself doesn't mean that the declines stop on a dime.
Lindsay, we're about to go into earnings season again, really in full swing. I know you track the expectations. If FedEx or Nike, some of the early bellwethers are any indication, it's going to be a little bumpier than the previous season. What are you looking for?
Yeah, it's not going to be an easy trek, not this quarter. We've actually seen going into the reporting period, though, estimates have come down for the first time in at least 4 quarters. So that's a good sign for corporate America. Of course, like you mentioned, FedEx, Nike, and others like General Mills, they've mentioned the issue that supply chain pressures are putting on their profitability. And that is certainly a concern. And you're going to hear it across the board, across industry sectors, how it's impacting margins. And so that's going to be a key watch item for investors this quarter, no doubt at all. But I do think that it's not a one-size-fits-all story, because you have seen companies like Lennar or Darden, for example, say that they've been able to maintain or expand margins. Of course, Lennar is in an industry that they benefit from that. And then you've got Darden, that is a company that is going through structural changes. So it's not going to be one-size-fits-all, but you look at the S&P 500, EBIT margins or operating margins, they've expanded quite substantially over the last couple of years. We're about to hit 16% on a margin level, going to 17% next year. I think, of course, that's going to come down, and that can be under pressure the next couple quarters. But that compares to 14% historical average margin. So I think we're in that mid-cycle. Investors have to get used to slower growth, but growth that is still above historical trend.